And welcome everybody. This is the Thursday night weekly update. We did miss last week, but there is a lot of prep. We did a lot of portfolio adjustments in light of the volatility, and I'm sure you'd like some answers to figure out what has happened, what is happening, and what may happen. There is a huge rotation happening right now. I think we have a lot of slides to go through. We're going to have I'm going to keep a quick pace, get you as much of the information, show you the portfolio adjustments we've made, things that we, that we feel reflect the current environment with elevated volatility, major rotation. We've done a lot. There may be more to go. So without any further ado, let's dive in. Okay, here we go. The great rotation into the next bear market, maybe not. I'm going to be flying alone tonight. Kyle is on the road driving to meet some clients tomorrow. So I'm going to be flying alone, though. I always miss when Kyle's not here. He's got really good perspective, different than mine. And, he's got his own way of looking at the markets, and it's excellent. But I'll give you what I have here. So who are we? If you don't know, we are Inside Edge Capital. We are a digital boutique wealth management firm featuring active portfolio management, fully integrated and comprehensive financial planning, which is key, especially in elevated volatility times like this when your emotions are running high. If you don't have a plan, that's when you can really make some bad decisions and fly by the seat of your pants. And high-touch, customized client interactions, which is why Kyle's driving up to see clients tomorrow. All right, enjoy the ride to financial freedom. This isn't a stock photo. That is me. I'm old where I wouldn't be doing dangerous jumps unless it was pre-planned. I knew it was below me. I knew what the risk was, and there was like 8 feet of powder below. So it was a very soft landing coming out of a 360. That's just not a straight jump. That's a 360. Didn't land it, but didn't feel a thing. All right, so where are we? In the short term, less than 1 month on the market outlook, we've gone down to a -2, which is quite bearish. Not quite down to 3, but a 2. On the 1 to 3 month mark, we've gone from a +2 bullish to a +1 bullish. I still do think the trend is up. We're going to look a lot at the markets and the technicals of the market. I think you'll see that the trend is still intact, though the lower parts of the range are being challenged. Long term, 6 months out, I think we're higher from here. There is, for me, no question that we are still in a secular bull market. The AI evolution is still intact. The vehicles and stocks and the phase of the build out that we're happening to be in, I think, is in question. And that's the valuation, that's the rotation and the questioning of the valuation of stocks that have already been pushed forward. But I think it's different areas of the market that investors may express the continuation of the AI trend. So stock selection is continuing to be key here. Okay. All right. Come here. Here we go. All right. Perspective. Perspective is key. You have to have perspective in this market. And I think looking at not only the financials, the fundamentals, but looking at where we've been, where we are, and where we may be going is very key. Step back and get the 10,000 foot view. This mountain actually might be higher than 10,000 feet, but get the 10,000 foot view of where we've been, where we are, and where we may be going. It's times like this when the markets are closed, it's quiet, the kids are still awake, but they're going to bed soon, where you can take a deep breath and look at what's actually happening, exhale, and set the emotions aside. When I've been trading since I was 16. I'm now 47. When it's 9:30 to 4 on the East Coast and the markets are ticking, you see things differently than you do after hours. That's why I love doing after hours work. Okay. So if you're hiking up a mountain, the trail wouldn't go straight up. It would zigzag, flatten out, and even dip briefly, but you're still gaining altitude. If you wanted to climb this beautiful mountain, which this is in British Columbia, Canada, I took this picture, it certainly wouldn't be a straight hike. There'd be twists and turns and many false starts, false summits. You have to, move down before you get around. And, there's no straight path to where ultimately going, which is your financial finish line, which is why we're inside edge. It's no direct path. And the markets are no different. Are we headed for more trouble? Are we doomed? Should we sell everything and go to cash? No. Volatility is uncomfortable, especially as we've gone straight up since Q1 of 25. Since Q1 of 25, the market has gone straight up, and this is the first bit of volatility that we've been presented with, and it's uncomfortable. On the same day, yours truly turned 47. The groundhog saw his shadow. Does that mean 6 more weeks of consolidation and or volatility or market selling off? Possibly. The range that we're in, that I've been conveying and pounding the table on to gain that perspective with clients, began in October 2025. We are now below the December 17th low as of today's close. The question is that I'll present to you, are we going to go challenge the November low, which is going to be at the rate of ascent of the 200-day moving average, probably right around that zone. That should be, it will be our next significant test if we get there. So let's step back and look at where we are on the charts. Here is that low from Q1 of 2025. In the NASDAQ 100, we've rallied 58%. We are 5.8% off the highs from 2026 highs. Let me say that again and be a bit emphatic. We are 58% off of the April 2025 lows. We are 5.8% off the 2026 highs. That is a 0.1% retracement. Okay. The S&P is up 45% from the 2025 lows. We are 2.5% off of the 2026 highs. That is a 5% retracement. The Dow Jones Industrial Average, we're 36%, only 36% from the March 2025 lows. We are 1.35% off the 2026 highs. We were very overbought. We're coming off, and the index damage is minimal, but there are so many stocks that are AI driven that were very overstretched on the top side that have come off sharply. And in our active accounts model, which had a lot of high flying stocks, we've taken a pretty big drop because we've been very long AI, which that's what this account is for. Right. So there has been some stocks that are up significantly that have come off quite a bit, but this is a small percent of our overall portfolio. The two main equity portfolios have a much higher degree of correlation to the indexes, though we do look for marginal outperformance, with active management. The drawback has been quite insignificant, I would say, in the context of how much we're up, not since early 2025, but even since the 2022 lows. So if you look at the NASDAQ 100 here at the 200-day moving average, we were stretched, okay? Heading into that October consolidation, the 200-day moving average was 19% the price action was 19% above the 200-day moving average. The second time in 2 years. The last time was July 24, when we were, again, 19% away from the 200-day moving average. Okay. The only other time before the 22, I should say the only other time after the 2022 sell-off was in 2023, when we were 26% above the 200-day moving average. So as the rubber band gets stretched, either the rubber band snaps back and hits you in the hand and comes lower, or the moving average drifts higher, while price action goes sideways, which we're actually getting more of the latter. The moving averages coming up as in the context of where we've actually been in this spectacular secular bull market. The NASDAQ and the S&P are basically sideways in the context of where we've been. Let's switch over to relative rotation graphs and let's start comparing key markets against other key markets that are related. Okay, we're going to use relative rotation graphs, and if you've been following us before, you know that we love this tool. So if you don't know it, real quick, RRGs, instead of the traditional XY axis chart, the RRG is a 360-degree depiction of a group of securities rotating generally in a clockwise direction against a central benchmark at the quadrant intersection. So what that means is quadrant intersection is the X right here. So it could be anything. Usually it's the S&P 500. It could be, some all stock market index, some big overarching collection of stocks that serves as a benchmark. And then you'd plot the securities and you literally see them move around in a clockwise fashion. As you're moving higher, you're picking up relative momentum up here. And as you move to the right, you're picking up relative strength. So the momentum's on the left, up and down vertical axis, and the strength is on the right. When you're up here in green, you are relatively stronger in terms of strength, obviously, and momentum. If you're down here, you're right of the vertical axis here, so you have more relative strength. But if you're dropping down here and heading this fashion, you're losing momentum. Down here, you have weak relative strength and a weak relative momentum, and you rotate back up, you're going to pick up relative momentum, but you are not relatively stronger until you cross the east-west divide. Okay, so basically you could see this, and if you had live charts, you literally can scroll them and see them circle around in a clockwise fashion. That's going to give you underperformance, outperformance, relative strength, relative momentum. There's relative momentum there. Okay. So first thing we're going to look at is the Vanguard Flagship Growth ETF versus the Flagship Value ETF. If you're on the right side, which is the Eastern Hemisphere, you have relative strength compared to the benchmark. Okay, the benchmark I have here is the ETF ITOT, which is the total U.S. stock market ETF. It encompasses everything: large, mid, small, micro cap stocks. It's the broadest representation of stocks in the land. Okay, so being that the VUG, which is the Vanguard Growth ETF here in the monthly, is way out to the right, that means over the last 12 months, by far VUG, which is the growth ETF, is by far stronger than both the benchmark ITOT, all stocks in the land, as well as value. Okay. But what's happening is we tried over the last 12 months to get a rotation. It was trying to move out here 6 to 7 months ago. Started to move up and try to get back into monthly leading, but over the last month, we had a sharp oops to head back down out of favor. As the growth ETF is rotating out, the value was trying to rotate down and out, like good night value, be all long growth, and then we just got another oops here on the monthly. So what's happening is we're seeing a little bit of a false break in growth. Growth has taken a big stumble here, where value has taken a stumble in favor. On the much more sensitive weekly, which began, I moved to, I'm going to focus on the weekly here. This is October 10th. Okay, that's when the market, the NASDAQ, went into the range. Value, which is in green, went from the lagging quadrant up into improving and made a strong move from improving into leading. That's October 10th. Each dot here is 1 week. And then the equal and opposite reaction is value rotating down out of leading, crosses the divide here on October 10th into weakening. And now we have growth well to this side. Now, what's going to happen? If growth continues to go in this direction, growth is continuing to rotate out, and that means value will rotate in. Okay, so we have to watch. If this continues, I'm going to go backwards, then the value up here on the monthly is going to continue to rotate in as growth continues to rotate out, and the volatility that you've seen in the high growth AI names will continue. So we have to watch this. This is a really important chart. We're now looking at sort of agnostic of value growth. We're just looking at small cap, mid cap, and large cap, both. So we're going to have value and growth on both smalls, value growth mid, value growth large cap. The monthlies on the left, weeklies on the right. So what's happening here is large caps have been hanging around the right side, the East Coast, which is the relatively stronger coast. Mid caps have tried to rotate in, did a big rotation out. Small caps are starting to zig and zag here, starting to move into favor. So small caps on the monthly are starting to rotate in. On the much more sensitive weekly, small caps are confirming what we're seeing on the monthly. Small cap stocks are getting more attention. Behind that, mid caps are starting to come in. Large caps are rotating out. And that's kind of what we're seeing. You have a rotation out of large caps. You're starting to see that little bit of wiggle on the monthly large cap. That is corresponding to the large cap VUG growth ETF that is doing that little oops. So we're seeing a stumble in large cap stocks, which, the mega caps are the hyperscalers, super large cap mag 7 that have been rotating out of favor. Okay, so this is all things we are going to continue to monitor and watch. I don't know what is going to happen. Okay, I'm just going to tell you that right now. Nobody knows what is going to happen. We are not in the prognostication business. We're not in the forecasting business. We're in the current assessment business. Our job, I come down here in my trading office every day and I look at our positions. I look at, our fixed income, tag, SIG, active ops. I look at our positions every day and I look over my left, right shoulder, look behind me, look ahead and say, do I like the positions that we have right now? You have to go through your process, look at all of the different resources available to us and reassess every day. Do we like the positions we're in? And if the answer is yes, you stay with it. Okay. To try to foretell what's going to happen in the future is a waste of energy. And it's not something that is a good use of your time. Your job is to thoroughly assess the now, not waste energy on the impossible task of trying to figure out what's going to happen in the future. Okay. All right, now let's get a little bit more granular. We looked at value growth. We looked at small, mid, large cap. Now let's look at small cap growth, small cap value, mid cap growth, mid cap value, large cap growth, large cap value. This is the weekly RRG. Up in the leading quadrant, and this is what I find really interesting about this market. The stocks that are leading right now, think about this. U.S. small cap growth, U.S. small cap, U.S. large cap value, and U.S. value. So we have large cap value, all value, the small caps, and small cap growth. This is what's so interesting to me. Like, small caps are in favor. We know that. The small cap growths are still in favor. Even with the AI sell-off, value we know is in favor. Coming up behind us in the improving quadrant blue is mid caps, which no surprise. We already looked at mid cap, a couple slides ago that was rotating in as small caps are already moving in. So mid caps coming in, small cap value, mid cap value. All right, so all together, all the values are present. Large cap values already in the leading. Mid cap value is coming up almost out of improving into leading. And then small and mid cap value are both doing that, almost out of improving, coming to leading. So we know value's there, but small cap growth is there. And then where's mid cap? And then mid cap growth is way, way out of favor. It's so goofy in here. In the lagging, again, is mid cap growth, growth index, large cap growth. So we know growth is out of favor right now on the weekly. We absolutely know that. The selling has been done. And I don't want to harp on the RRGs too much, but we're so overdone over here on the RRG with growth. We could rotate back up and all of these guys that are already in leading could rotate down. We are right in the middle of earnings season, which anything can happen. And as I show you later, as we get off the RRGs, we're still in a range. We have not yet broken support levels. So this very well could happen. Another tool I want to pull out is ratio charts. This is really, really important. For this section, we're going to use ratio charts. Instead of looking at one security by itself, we're going to divide one security into another to see a ratio. It's a quick way to see relative performance of one security versus another. Okay. RRGs are a wonderful way to look at a basket of securities against one benchmark. Ratio charts are a great way to look at one security relative to another. If one stock is at $10 and another one's at $1,000, you can't really look at charts to see a percent moves, how one is moving relative to the other. The best way to do it is to divide them into each other. For example, let's look at stock ABC versus stock XY. That's supposed to say Z, but XYX is fine. Oh, there's XYZ. All right, so here's the ratio. If you divide ABC and XYZ and the stock is moving up, their price chart's moving up, you should know what this means. You probably do, but if you don't, it's helpful. If the chart of ABC, XYZ is going up, ABC is relatively stronger than XYZ. And this is the key. They both can be rallying or declining on their individual charts. Let me say that again. They both could be going up in a bull market, and they both could be going down. The ratio measures the relative performance of one versus another. So if both stocks are declining, ABC and XYZ, but the ABC XYZ ratio charts are moving up, that means ABC is selling off less aggressively. It's showing more relative strength than XYZ. Said differently, XYZ is weaker than ABC. Both stocks could be going up at the same time in a bull market. That means ABC is stronger than XYZ. This is another way that I used to trade for an FX hedge fund during the global financial crisis. If you have Euro USD, it's the same way. If Euro USD chart's going up, Euro stronger than dollar. If dollar yen chart's going down, dollar is weaker than yen, yen's weaker than dollar. It's just a quick way to look at that. All right, so again, let's look at value growth ratio. I'll tell you what, this one's a little scary for me. Okay. I don't want to say scary. I like the bull market. I like the tech growth bull market. But you know what? In our short 5 years of wealth management running money, we've been tested with a significant rotation in a value. And if we're happening again, bring it. This chart's a little scary. So this is the VUG VTV ratio. And you can see here's 18, there's 2020, and then in the inflation, fiscal and monetary response to COVID pandemic, Fed spurred a bunch of inflation because the shutdown in economy was going to send us into a deflationary spiral. So the government threw the fiscal and monetary policy tools at it to drive inflation up, and they got it. So what happened was right here. Those dates are off real quick. So it should be 19, 20, 22, 20. You can see it at the bottom here. Okay, so the uptrend is broken. Those are not correct. The uptrend is broken here in 2021, growth outperforming value. We sold off quite significantly, okay, into the low in 2023, which is right here. We found the low, and then the growth trade reemerged, moving up stronger than value up to the peak that we just saw in October. And now we're selling off again. The uptrend is broken in 2026. Are we going to see another significant downtrend in the VUG VTV ratio, which means VUG is relatively weaker than VTV? If the market is going higher, that would mean that value stocks are outperforming growth stocks and the market's looking for safety. Okay. If by chance we were to false break and snap back above this uptrend and the stock in the bull market continues, growth is going to continue to outperform value and you're going to get more alpha there. Okay. So let's continue on with the VUG VTV ratio. All right. Now these dates are correct. 18, 20, 22, 24, 26. Okay. So what you're going to notice, there is a correlation between the ratio of growth to value to U.S. Yields. And the 10-year yield is the benchmark for the American economy. And what happened was post-pandemic, we did rally. VUG, VTV rallied. We broke down into 21, 22. The market went out of growth into value because inflation spiked to multi-decade highs as yields went up. Okay. And the Fed was forced to raise rates. We were scared of the thought of stagflation, which is low growth with The Fed unable to cut rates because inflation is raging, rates are high, they can't really cut growth because there's no growth, can't cut rates because there's no growth. So that was the market's reaction to post-pandemic, 22, 23. We've fallen into a consolidation in U.S. 10-year yields sideways, which has allowed growth value ratio to continue to move up. Now, the next chart, we're going to look at this consolidation in the U.S. 10-year yields. We've held the lower end of this triangle consolidation. What happens if yields go up and break out of this consolidation? If that's the case, looking at the history, which is very recent, only 2, 3, 4 years ago, if yields do embark on another push higher, we might see the breakdown of uptrend support here continue. Value rotates in, growth continues to rotate out, and we really need to go protect ourselves from the AI trade that we've all done so well on and fallen in love, and the market's come off sharply, and it's our time to now really look at what's happening and say, do we need to protect more so than we've already done? And on the other hand, let me look at yields in 18, 19, and 20. Yields drop sharply, right? And that favors growth stocks, right? If yields drop, there's not as much yield to be made out there in fixed income and the other securities that pay yield. So people are more willing to go out and pay for growth and earnings that might be substantial 2 to 3, 4 years down the line, because the opportunity cost of paying for high growth stocks is not as severe in a low yield environment. And that's why I saw 10-year yields drop, and that would allow growth value to move higher. So we really need to see what happens with this consolidation in the right here. Could U.S. yields and corresponding inflation expectations drive another rotation in value? Remember, declining VUG VTV ratio means growth underperforms value. Said differently, value outperforms growth. So here's the U.S. 10-year yield chart going back from October of 2022. It is a coiled spring. And not a lot of people are talking about this. I don't think the stock market is selling off in anticipation of rates breaking higher, though it might be, but I think we're giving the equity market too much credit. It doesn't look that far ahead. Fixed income, currency, and commodity markets look out much further than does the equity market. Equity market's selling off for various reasons. We're going to stay out of today. I really just wanted to focus on the technicals of today and look at where we were, where we are, and where we may be going. So, we are certainly very tight. Resistance up top at about 4.6% in the 10-year yield. Support down below about 4.1. I mean, this has been in play. It's October 22. We're now in 26. It's February. 8 more months, right? And that's going to be 4 years inside of this consolidation. It's high time to break. I don't know which way we're going to go. I don't know. I can't tell you. But I can tell you that there's only so tight you're going to coil this spring before it's going to break higher or lower. So let's continue on with the inflation and rates conversation. So this is the 2-year yield. We're just looking at the 10. This is the 2-year yield. This more closely corresponds to where the Fed sets their policy rate. We also have new Treasury Secretary. We've got Besson in, and we've got Wersch. Wersch is actually from 45 minutes down the line. Both guys trained by Druckenmiller, arguably one of the best traders of all time. Soros, Druckenmiller, like, you've got two very sharp government employees who are watching over the economy. That is a very bullish thing in and of itself. Both guys are very, very astute at markets, not just public sector guys. So that's helpful. Now, the 2-year Treasury down to 3.5%. We can clearly see the 2-year yield does roughly follow where US CPI year over year changes. You could see there's a pretty big gap that's opened up between where 2-year yields are and where CPI is. CPI is over here on the left scale, about 2.3%. That's what the government's reporting. There are sources that say it could be lower. But we can clearly see the gap between 2-year yields and CPI is quite wide here. Back in 1819, what happened is yields dropped and caught down to inflation. Is the same thing going to happen again? I mean, does inflation start to, or does the 2-year yield start to drop? Does the Fed have to cut rates again? That's a pretty big gap to make up. So we have to see what that means. Either inflation picks up and catches up to where 2 yields are, or two-year yield treasuries drop to where inflation is going to be. We're going to have to monitor that. Trueflation, which is a much better depiction of where CPI and PCE is, shows us pretty much like that October, it was key. We did a little double top just like the market did, and then has been selling off significantly. Trueflation is showing us at year-on-year change of 0.93%. The Fed's target is 2. CPI was printing, 2.3. Trueflation is showing it at 1. That's almost deflationary. So that might mean that the Fed could cut rates to catch down to where the reported CPI inflation is. And if trueflation is accurate, it's down here, which means the Fed has more rate cuts to come, which would boost and stabilize the stock market. And I'm trying to stay away from this right now, but who knows what's going to come out of the White House? That's the other thing that's driving the market insane. Is like you never know what's going to come out next. It's like every other day there's a new headline that's driving some corner of the market crazy. Okay, so the Fed is not set to cut until not in March. There's a 1/3 chance of a cut in April, but an 86% chance of a cut in June, 79% chance staying at that 1/4 point cut in July, and then another cut in September. Long ways away from that. I have a feeling those numbers are going to push up if the volatility and the rotation into value and the sell-off and the excess speculation that we've seen. Bitcoin just dropped below 60,000 tonight. We caught all Bitcoin out of IBIT in our growth portfolio. And I know there's some people who've been holding Bitcoin for a long time, and I know it's painful. But for our models, we've cut it. Okay, let's look at the NASDAQ S&P ratio. Okay, so in 18, 20, 22, 24, 26, we did have a congestion about 3.5. Okay, NASDAQ into the S&P. This moving higher, obviously the NASDAQ's outperforming the S&P. We made a peak. We dropped here. Okay, this is the October peak. We dropped. NASDAQ underperformed the S&P. Using simple technical analysis, you have a broken trendline resistance that may offer support. You also have this congestion pivot zone at about 3.5. We're at about 3.61 right now in the NASDAQ S&P ratio. If we move down to this level, we're going to watch to see if this continues to be a pivot in the NASDAQ 100 S&P ratio. If it does and holds support, that means the NASDAQ weakness relative to the S&P, tech relative to broader markets, is just in a pullback, finding support and ready to move higher. Great buying opportunities. And that's the question. Is the significant sell-off and such a violent sell-off in some of these super high valuation, even pre-earnings, AI infrastructure, future build-out companies, the pullbacks are so severe, but they're up hundreds and in some cases thousands of a percent. Are there massive buying opportunities for the next wave up? There's so many people who are, not so many, there's enough people that I greatly respect who are so in tune with the technology build out, who are saying we're in the second and third phase or second and third inning of this tech build out. And the few that I really do respect feel very strongly about that. So it remains to be seen. And again, holding this 3.5 NASDAQ to S&P ratio is going to be a really good start. NASDAQ small cap. Now, as we mentioned, I showed you on the RRG how small caps are moving in. Trump has a very protectionist onshoring, reshoring, nearshoring policy, putting America business first, trying to cut us off from the rest of the world. He feels America has been paying for too much foreign affairs that really don't have anything to do with us. He's trying to cut us off before the markets start to question our debt to GDP ratio, which may push our interest rates higher and really call into question the viability of our debt markets. He's trying to get spending under control. He's trying to secure natural resources. He's trying to, just secure energy independence as any nation, any sovereign nation should. We were very quickly reminded of that with the Russia and Ukraine situation with natural gas out of Europe. So I don't, I'm sticking on a technical path here today, just showing you what has been, what is, and what may happen based on key market movements and developments. So the NASDAQ small caps, okay, as I mentioned, small caps have been coming into favor as tech has been falling out of favor. If you do a simple parallel channel, you have a high, take a snapshot, move it up off the low. It's amazing how many times formation, you wouldn't be able to draw a trend line with just one point. But if you source the angle from the upper part of the channel, so many times that winds up being support. This is a really interesting point. Call it 9.3, 9.2 in the NASDAQ 100 Russell 2000 small cap ratio. If we're to hold this level, the NASDAQ's on sale and small caps are overbought. It's an interesting concept. This one is concerning to me, and concerning from the point of I like the bull market in growth. I like being long growth in tech stocks. This chart for me is the most concerning chart to that bias that I have, that I like being long American growth. This one, which we've already started rotating overseas, and I've been pounding the table for a long time. Oops, come on back. I've been pounding the table a long time that so many money managers had investors coming into us with international exposure over the last 10, 15 years. International has done nothing. And there's so much opportunity cost being spent having money overseas. I'm saying that's just really unfortunate, because there's so many returns with that money that have been missed and not captured here in the US, as money managers are waiting and waiting and waiting for emerging markets to finally catch up. The last time emerging markets outperformed the S&P was in 2008, and now we're in 2026. But now we're starting to see it. It only took 18 years, and we've already begun rotating overseas. All right, so this chart right here, I find very, very interesting. S&P 500 to the All World Index ex-US. So this is emerging markets and developed markets outside of the US. Ratio from 2008. This is a highly concerning chart. Since 2008, each significant low in the chart was followed by a higher low and then proceeded to new highs. So what does that mean? Each significant low, which is this little black half semicircle, followed by a higher low, which is a yellow square. So each significant low in the market was followed by a higher low and then proceeded to new highs. Significant low, higher low, new highs. Significant low, higher low, new highs. Significant low, higher low, new highs. Significant higher low, new highs. Significant low. That looks different to me. That looks significant. If you were to break down through the current level of 9.6 and then 9.5, there's evidence to say the uptrend of US stocks relative to the rest of the world, the alpha, the outperformance in the US relative to the rest of the world, may be over. And that would be quite alarming. Okay, we've been riding US stocks all the way up. Do we catch the top? No. We don't try to catch the top. I had a nice client interaction today. He's like, Todd, why didn't you sell AI stocks at the top? I said, sir, I'm never going to sell the top. I'm never trying to get the top. I am going to be long through the top. And once we see the rollover breaking support, well, then I look back and say, okay, I think we may have seen the top. It makes no sense to try to get out here. Oh, I was right, sell off a little bit, then make new high. Try to get out here. Oh, good. Make new high. Try to get out here. Make new high. No, I want to be long through the top and then sell into weakness. That is a way to capture as much of the trend as you possibly can. Nobody knows where the top is going to be. Nobody does, right? But this is the way, this is my style to be long through the top. And then we're going to scale back once there's evidence to show the reversal is upon us. But we've been fully capturing, since we launched here in 2021, we've been fully capturing US outperformance of the rest of the world. It may be time for a change. Below 9.6 and the 18-year trend of US equity outperformance may be over. US tech, okay, XLK to all world index. To further drive home this point, US tech to all world index XUS is showing a very strong suggestion of a topping pattern. See how messy and choppy this has gotten relative to what we've seen since 2005, 10, 15, all the way up? Almost a little head and shoulders pattern. Below this, in technology, American tech compared to all world XUS may be breaking down. S&P to emerging markets. Okay, same concept. You connect the high to high, parallel channel, projected off the low. You have S&P to emerging markets support right here. Emerging markets, a lot of it's Asia. Latin America has been a huge recipient of flows. We have new Latin America exposure. There's been wonderful moves in Peru and Argentina and Colombia and Mexico. We added emerging markets, EEM, and we added Mexico, EWW, to our tag portfolio, which we're going to go over here in a little bit. We may need to do more, but this is a critical level. If by chance we hold here at 11.7, sell the rest of the world, buy back into the US. This, I mean, it's crazy. A couple squiggles on the chart like this will allow you to make a conclusion as drastic as what I just said. Sell the rest of the world, buy US, if this little squiggy line holds. But that's what this represents. That's the power of charts. That's why I really like to consider myself a visual investor as much as I am looking at the fundamentals of our individual companies that we hold and the macro and the fundamental data out of the economy. But it's really important to see where capital flows are going. Capital flows discount into the future. Markets are constantly discounting what they think is going to happen in the future. Markets don't trade on data that comes out today. It's hard to believe, and all of my friends at CNBC, my beloved friends who I've known for so long, are reporting on the news. Here's the data that came out. Here's why it happened. That's wrong. Markets are constantly looking into the future. Equities on average 6 to 9 months. Commodities are like 9 to, I forget the numbers, 9 to 12 months. Currencies are longer than that. Fixed income is the furthest, so like 18 months out. Markets don't trade on the data that's happening today. Capital flows go into markets in anticipation of what's going to happen 6 months, 9 months, 12 months, 18 months from now. Sometimes they get it right and the market sells off in reaction to the data, the positive data coming out. Sometimes they get it wrong and the market goes crazy. But the markets are constantly trading based on what they think the data is going to be in the future. That's why it's important to know what the fundamental story is now. See what's being reported in the news, social and traditional media, and then look at what's happening on the chart and say, is there a disconnect? Is the market pricing in something that the collective market thinks is going to happen in the future that's not being reported now, that's contrary to what's being reported now? Because the negative data that may be reported now was priced in October when the NASDAQ stopped going up. That's how you have to think of the markets. Like I'm trying to explain to the new guy who joined us, Garrett, and he's like, I have never heard this in my life. He's like, what? I'm like, well, that's the twisted reality of markets. Okay. So we got to watch this SPYEM. Below 11.6 and the 15-year trend of U.S. equity outperformance versus emerging markets could be over. Semis. Okay, let's go back to the U.S. Now, there's so much happening with the technology AI trade selling off. Everyone's like, oh my God, tech is getting crushed. Well, if you look at the SMH to S&P 500 ratio, it actually looks fine. With NVIDIA going nowhere, there's some semis that have sold off significantly, but there's some semis that are doing great. The SMH SPX ratio from 2025 is completely fine. Any little pullback into the uptrend, like buy semis. Okay. Let me just make sure we're right on pages. Good and good. Okay. Changes. What should we make of all this, and should we be making portfolio adjustments? Yes, there's been a drastic rotation out of high growth AI into value, cyclical, and growth at a more reasonable price, GARP, growth at a reasonable price. Have we seen this before, and what's the plan? The answer is yes. When we launched Inside Edge Capital Management, which is October 4th, 2021, we were just coming out of the end of the pandemic. Inflation was raging, volatility was up, and of course, leave it to me to launch the wealth management business then. It's something I've been prepping for over a decade. So when we came to market, the markets were going crazy. And we had the growth portfolio and we had the dividend portfolio. I don't even think we had named them at that point. This is the first sector allocation for our growth model, which is meant to mirror or compete with or outperform, hopefully, the NASDAQ. When we came to market, I said, this is not a traditional growth market. This is a inflationary, interest rates moving up, inflation sensitive materials and energy are pushing higher. So when we launched with energy at 11% allocation. S&P's allocation of energy is 2.77%. So we're 8.3% heavy energy to the S&P in a growth portfolio. Energy is not growth. Energy is like the trading at 12, 13, 14 PEs, 5% top and bottom line growth. Like there's no growth in energy, especially in 2021. So, but we identified it for many of the reasons I've already discussed. So when we came to market October 4th, 2021, to be, market weight energy, the S&P is 2.77%. We came out of the gate 11%. And you can see energy rallied, energy relative to the S&P rallied. And as soon as we came out of the gate, we're like, I'd like to be long technology, but not in this market. So energy served us well, and we got out of the gate with a very strong performance because of energy. So IEC launches here. That was October 4th, 2021. We rally up. Since then, energy has been sideways, hasn't gone anywhere until a couple months ago. The rotation into value, more cyclical, has broken energy higher. Are we starting to see an end of the downtrend of the XLE S&P ratio? Here we go again. We're 4.5 years after launch and energy is starting to move up again. What's the reason? Is it inflation? Is it deregulation? Is it realization that fossil fuels are going to be with us for a lot longer than we would like? EVs and battery power is going to be a lot longer out until we can secure rare earth minerals. The administration is doing everything they can to secure rare earth minerals. So much in Latin America, so much in China. This is a challenge. So for whatever reason, and we may not know the exact reason or group of reasons until months down the line, but right now the market is discounting that energy is breaking resistance and capital flows are moving in. So possibly here we go again. So as I mentioned before a couple of times, here's the NASDAQ 100. We rebalanced the portfolio TAG on December 17th. TAG stands for Tactical Alpha Growth. This is our growth portfolio. I didn't like how we failed at the October high. So we started to sell off. And on December 17th, I said, okay, hold on. And I did something drastic. For the third time in our history, we raised as much as 20% cash in our growth portfolio. Our two big equity portfolios are TAG and SIG. Tactical Alpha Growth and SIG is Strategic Income and Growth. To raise 20% cash is a big deal for us. Okay, so I moved 20% of cash to the sideline on December 17th. I was afraid that we were going to go hit the November 21 lows. As soon as I sold it, we rallied back to the highs. And I said, oh, Todd. Again, everything that I saw was like, okay, it's time to take some money off the table. But it's the market's sick and twisted, sadistic way of messing with not me, but everyone. I said, oh man, am I going to have to put this back to work at higher prices? I just saw everything I saw is like, I don't think it's the right thing to do. I'm going to leave it. I know tag performance was actually outperforming the NASDAQ, even with 20% on the sidelines, because we had the right stocks up through here. So I was like, I was watching performance every day. I was like, okay, I'm going to leave the 20% because we're actually not only keeping pace with the NASDAQ return, we're beating it. And then the last week just happened. I said, okay. So today we started to break. On February 3rd, we went back to December 17th lows. So I said, okay, it was the right move to put 20% cash. The other adjustments that we made on December 17th, we cut technology by 4%. We cut communications by 3.5%, cut industrials by 2.5%, cut utilities, cut energy, and we moved into 20% cash. Today's the 5th. On the 3rd, we made another move. Okay. We made another adjustment. February 3rd, we took 9% of the 20% cash that we put in BIL, which is short-term treasury ETF, and we put it into an inverse ETF. PSQ is what we're holding. 9% position. That's our biggest holding right now in the growth portfolio, 9%. We still have 5% cash, okay, in BIL. We also took some other money and I rotated 3% of it overseas. As I told you, there's some rotation happening overseas. I put the money also back to work in energy, industrials, financials, and further cut technology. Again, this is the growth portfolio. This is supposed to compete with the NASDAQ and to only be 16.5% allocated to technology with a portfolio or model that's supposed to compete with the NASDAQ. That's a big deal. Right. And we have 9% that is inverse, 5% cash. We're well overweight energy, utilities, and materials. We'll talk about that. So now we're back to the December 17th low, and today we close below it. Today I was watching the battle, trying to hold the December 17th lows. It broke below, it closed below, but it wasn't decisive. I find it interesting. But the big thing that I want all of us to take as I take a drink of water, take a step back, take a deep breath, and look at this chart. Look at this NASDAQ, and where have we gone? We're at the same level as we were in mid-October 2025. We are sideways. This is why charts are so good, to get the perspective and just say, okay, forget about what I think is happening. Forget about all of the news and data that's just clubbing me upside the head all the time with social and traditional media and so many people competing for your attention. Just take a deep breath and say, what has happened? Nothing. In the indexes, nothing's happened. Yes, there's a great rotation happening out of growth into value. Is it going to continue? We shall see. So far, it's been a pretty significant rotation. I'm certainly going to give it that. But it may be just a swoop down, a push to shake out weak hands, maybe even down to the 200-day. And as soon as enough people throw their hands in the air and say, forget this market, it's stupid, I'm out, I'm scared, that's when it goes. I've seen it enough. I can't wait to see what happens. So as I mentioned, February 3rd in TAG in our growth model, we made the following adjustments. Decrease technology 5% to be, we cut by 5%. 16.5% is the holding of tech and TAG. 17.53% underweight S&P's weighting of technology. S&P is 34% allocation to tech. We're at 16.5%, so we're half the weight of technology. Okay, we increased financials 3% to be equal weight to the S&P. We increased industrials 2.5% to be 5% overweight. So industrials, we're at 13%. We kicked it up by 2.5%. We're 5% heavy to the S&P. S&P's weights 8% industrials. Increase energy 3% to be 1.91. We're overweight. Increase international holdings by 3% and deploy 9% of the cash in an inverse QQQ ETF. PSQ is the ticker as a hedge. And I just want to look at, since we've gone into this range, I'm doing this for investors, but I'm also doing it for myself and say, how did you do? What are the moves you made as the market's falling into this? And some notable under overweight allocations in TAG. Technology decreased in November 20 from 26.5%, which was still 9% under the S&P's weighting, to 22.5% to 16. So I've taken technology from 26 to 16. I've cut it by 10%. It's roughly half the weighting of tech to the S&P. Comms decreased from communications, Google, Meta, Netflix, Spotify, Charter, from 10% down to 7%, where the S&P's weighting is 11% in comms. Materials, in November, we went from 7%. Right here. Materials in November increased from 3 to 7. Okay, materials, right. I increased from the prior rebalance. I increased materials up by 4% to go 7%, which means I was at 3% in the prior rebalance. So it was at 3% off screen, 7%. Now in December, 7.5%, and then in the latest February rebalance went to 9.5%. So, prior to November, we were 3%, and then we tripled exposure materials. Whether it's precious metal buying for safety, risk aversion, devaluation of the dollar, or it's the reach for mineral shortages and rare earth minerals that are needed for the AI infrastructure build out, we don't know yet. But there's been a big move in materials. I feel like it's more of a grasp of shortage of materials that are needed to build out the critical infrastructure for AI. The realization, I think, is real monetization by the hyperscalers of massive data centers are 2 to 3 years out. We've got to build the pipes. We've got to secure the energy. You've got to build the infrastructure before Meta and Google and everybody else who's crushing data centers start to really turn a profit, see an ROI in the massive CapEx. That, I think, is what's happening right here. Okay. And there's a slide coming up and I'll show you more on that one. Okay. Energy, 5% allocation compared to S&P's 3.9. So we're overweight energy as well. Okay. So those are there for your reference. Okay. Bitcoin. I don't know. I'm not a Bitcoin bug. I'm not a, live free or die with Bitcoin. I first bought Bitcoin at $330 back here. I think I sold it up into this rally at 2,000 or 3,000. Here you go. I could show you my Coinbase. I bought like 10 Bitcoin at 330. I sold it into 2, 3, 4, 5,000 right here. I sold into strength. I thought I was a genius because I 10x my money. Good job, you dork. That's why I will always sell after the top. Look how much money I left on the table by thinking a 10x return from buying Bitcoin at $330 was a good idea, selling it at 2, 3, 4, 5,000. So the trend has changed. We have a significant consolidation congestion zone here, 60, 50,000. We'll get off the monthly. We'll go down to, come here. 62,000 is a key zone. So this highlighted consolidation from the monthly, you could see all of those highs, congestion, broke through, almost support. This is clearly the pivot point in Bitcoin, and it's right around the 67 to 54. I was driving home tonight and I saw a headline that we dipped below 60,000. There is a key technical zone in Bitcoin, A equals C. So this percent drop from the high here is equal to the percent drop from 97,000 to 62,000. I think we're there right now. I don't know my futures. I can check later. But this is a key zone. So this is going to be a sort of a barometer for risk and liquidity and the overall growth trade. So let's see what happens. If you start seeing Bitcoin decisively below 62,000 with a 5 handle, it could be going lower. We cut all of our IBIT holdings in tag. We've held it for a long time. I cut it. We're out. It's not like we had IBIT at a great price. IBIT only came out, Bitcoin ETF only came out, what, a year and a half ago or whatever. So it's not like you're going to have a great price. So we cut it. We're out. Risk management. Okay. On the bright side, why are transports ripping to new highs? As much as you want to say, oh man, sell our stocks, get out, get me out of the market. Transports are moving higher. They're breaking to new highs. And here are your weightings in transports. Uber is, which is even more crazy because Uber is a technology company. It's not a transportation company. It's technology. It's a software company. And software's getting wrecked. Uber's getting wrecked. That's the largest holding in IIT that's breaking out. Behind that's Union Pacific, UPS, FedEx is ripping. Old Dominion, CSX, Norfolk, UAL, Delta, Southwest, C-Trop. Like, transports are moving higher. And again, here I think is one of the main reasons the market is unstable and selling off. We're looking at the generative AI and technology ETF by Roundhill. And this is IGV, which is the software ETF. They were on track through 24, 25, even late 25. But again, that October time is where the divergence, the break came. Tech is getting, software is getting wrecked. Technology software is getting wrecked. Where the generative AI and tech ETF are off the highs, but they're not that much off the highs. We could have another leg lower, we may, but that doesn't change the fact that the gap that's opened up between generative AI stocks and software is massive. Here are the top holdings in your generative AI. Google, NVIDIA, Microsoft, Amazon, that's a South Korea company, Meta, Samsung, SoftBank, Minimax, Apple, Broadcom, AMD, Taiwan, Alibaba, ASML. And here's your software. Microsoft's getting wrecked. Palantir is, even with good earnings, getting wrecked. Salesforce, Oracle's getting wrecked. Intuit, Adobe. I've been trying to short Adobe for 2 years. Adobe's been a massive underperformer. Perfect example of a company that is completely being disrupted by AI. And I could see in the charts a year ago. Palo Alto, it's interesting that that's there. More security. CrowdStrike, AppLovin's getting killed. ServiceNow, yup. Synopsys, Cadence, Autodesk, Fortinet. So my thing is like, okay, software is getting crushed. Is that a big deal? Is that a referendum on generative AI? If AI is above and all the CapEx produced by the hyperscalers, then why have AI stocks decimated the software stocks that are ripe for disruption? Software is being sold off, which I think validates the future of AI. It renders many software stocks useless. And not to say Adobe's useless, but Adobe with the creative suite with large language models and how you can come up with graphics and, you're going to be able to just tell an LLM what you want to develop, and, Adobe Suite is in trouble, right? So it's like, if the whole AI trade is going to sell off, why is the AI trade disrupting a whole section of technology? And I think it goes to validate the future of AI once we get through this pocket of volatility. So I think we're not going to go too much into this, but I want you to just chew on this one for a little while and realize volatility is going to happen. As much as I try to get inside of every ebb and flow and every zig and zag, and I'm trying to extract as much value as I can on the upside, and I'm trying to protect as many valuable basis points I can on the downside and drawdowns. That's my job. Okay. And I'm doing it all the time, but you have to realize that you are in a 200 and what? We're going to be 250 years old, 248, 249 years old. We're going to be 250. What is it? I should know that. 2026 minus 1776. There you go. 250. We are in a secular long-term bull market. There is going to be volatility, but the chart goes from the bottom left to the top right. The biggest danger to security of your future is the biggest threat is to not be properly invested in the markets, whether it's US markets or overseas markets. The biggest risk, the biggest way to protect your purchasing power is in the stock market. Unless you can reinvest in your own business and drive value that you control, the very best way to protect your purchasing power and grow is in the stock market, more so than real estate. So look at this. An investor in a product that tracks the S&P would have had a 69% chance of generating positive return during any given quarter between 1926 and 2025. I gave you a chart from 1896. Increasing the investment horizon to 10 years would have resulted in a 95% chance of a positive return. And investing on any 20 to 30 year period would have produced 100% returns. So S&P index percent of the time, positive returns and range of returns over various periods. 69% of the time, 1 quarter, you're positive. Average annualized return is 3%. Smallest annualized return, negative 44. You can see what's going to happen as your investment time frame goes down. Over 1 quarter, your smallest annualized return in drawdowns is 44%. If you're in for 10 years, your smallest annualized return is minus 495. Largest annualized return is 21% over a 10-year period. Risking 4.95 to make 21%. To try to overthink that and time your way in and out of your investment portfolios is dangerous. We manage at the margins. I'll trim sectors that are working, add sectors that are working, that are reflecting a rotation into a future area of the economy that the market is trying to sniff out, that there's going to be growth there. That's our job. We'll attach the data to it later, but we're looking at charts to figure out where capital flows are going to discount where they think future growth may be. We're trying to manage at the margins, but trying to be in and out with your whole portfolio with those kind of data, that kind of data behind you, and especially with traders who are overly analytical and try to outthink the markets. Kyle and I have seen enough portfolios that there's been irreparable damage done to it, and we try our best to put it back together, but you have to trust in the longer term trend, which is up. So here's the Dow from that post 29 crash up into the 60s. We rallied 2,332%. We hung out in the stagflationary 70s, rallied again 2,390%. Here was the GFC, set in a low at 6,400. So far, after 2,300% rally, 2,390, we've only gone 660% so far. So post-industrial revolution, the first one, and 1929 crash, there have been 2 primary secular bull trends, and the third is still ongoing. There is a fib projection here. Key levels at 44,000. We hung there. This was 22. No, that's 23, 24. No, I guess it's 25. That's 24. That's 23. So we went up post 22. We went up to 23, 24, 25. Right. So we're through it. The next significant level, which would be another 2,300% rally, would be at Dow 148,000, as we're at 48,000 right now. All right. So hopefully that, I think, kind of sheds some light on this. Let me see if we can get full screen here. Where'd you go? Oh, there we go. Anyways, if you made it this far, I appreciate it. Nobody knows what the future holds. I'm not going to sit here and hold myself out to know what's going to happen in the future, but I think we've done a pretty good job of assessing the now. We have some critical levels on both the RRG and the ratio charts to know if the rotation out of the US and growth relative to the rest of the world is going to continue. There has not been a lot of moves in fixed income. Money is not rotating out of equities into fixed income. They are going into commodities. There is some movement in the FX markets, but the rotation has generally been contained in equities. And I think there's been, the weight of the evidence suggests that there is rotation happening, but I think it's strictly an overbought situation as the NASDAQ has gone up 60% since Q1 of 2025. We needed to hang out a bit. We need to shake out some weak hands. We may go down and test the 200-day moving average. We may shake out additional weak hands. We have raised 29% cash and tag. I am more nervous tonight with that much cash and a 9% allocation on an inverse ETF as I am being 70% still long equities. I'm more nervous having that 29% out of the market than I am the 70%. If I'm wrong and the markets continue to waterfall lower, we're going to continue to adjust on the downside. But the biggest risk is to not be in the markets with core portfolio exposure in line with your financial plan. If you have a plan laid out, you have the segments of money bucketed out with your financial advisor, and you know the money you want to take risk with, if you want to know the money that you want to protect and put some safe harbor on, great. You've got to be pre-planned. Only if you're pre-planned, you go through an exhaustive financial plan. Are you content with the risk that you face? And once you're content with the risk that you face with your risk capital, are you free to experience the full upside of that money? If you're going in without a plan and you're just trying to get excess returns and we'll figure out the rest later, that's when you're very liable and susceptible to costly decisions. So we'll leave it there. Let me know what you think. I hope that helps. If you made it this far, maybe drop a comment. Tell me what your thoughts are. I really appreciate you guys listening, and I can't thank you enough for your time. All right, we'll leave it there. We'll see you what the future brings. Have a good night.